I look at sourcing investments, these two red lines are really important.
Hi everyone, I'm your host Sophia Ling. I'm also the co-founder at Keel. Keel is a platform for you to browse leading investors' live returns and subscribe to their actual trades. Today's event is brought to you by Keel and CACC. A bit about the speaker, John Bay, a CFA charter holder and a UCLA grad. John has almost doubled S&P 500 the past year. He'll be sharing his methodology and one specific stock in his portfolio. Let's welcome John.
Thanks, Sophia. The one I'm going to be pitching today after I talk a little bit about my process is actually not a large cap. Traditionally, when I started investing, I did definitely err more towards large caps just because in this environment, valuations even in 2016 were pretty high. And so the large cap stocks that I was going after were the kind of ones that you would want to hold through a cycle because no one is really going to be able to predict when that downturn happens. But the one I'm going to pitch today is more of a mid cap, maybe even a small cap name. So I'll get to that later. But so just a little bit about my process and background that I've refined through the years. So I manage my own money, but I also manage money for my wife. And through her account, we actually own a lot more stocks. So my account is only about 29 or 30 stocks. Her account is much more quantitatively driven and has about 110 to 120 stocks in there. And the process that I use is basically, putting in the time to comb through the indexes and the exchanges. I try to do a little bit of that every week. And I put stocks on an email list, and the ones I really like, I'll evaluate a little more. And depending on what sector they're in, they're going to have to meet a different set of kind of criteria. And if they meet that criteria, then I'll go in and do a little bit of a deeper dive on the business model. And so the quantitative part really kind of does a lot of the heavy lifting. But then that kind of last 20% before I'm going to put it into a real live portfolio is kind of a little harder to define. And I would say I can't really come up with a set of rules that's going to define what's going to go in there. It's really, can I see that business model succeeding over the next 10 or 20 years? And so there are places in financial statements where those types of things will show up. The operating margin is a really good proxy for that and how that changes over time. Margins in general are just really important, I think. But at the end of the day, even some of those companies can be pretty vulnerable. So you have to have a different set of litmus tests for every industry, and you have to have a really good gut check before you make it into that quantitative portfolio. And so her portfolio actually serves as the bedrock for my portfolio. And so when I'm ready to take off exposure in my portfolio, which has had to happen this year, as financials have gone up, trying to rotate out of those and kind of put money to work in a more diversified way. I really want those 110 or 120 stocks. I want to be able to pick the good ones out of there. And so her portfolio does very well too, but I kind of use that as a wide universe to kind of source and use for investment ideas. And so together they do a really good job of diversifying us. And then, so the evaluation is more of a deep dive. Sometimes if it's less of a quantity stock and more of a pure value play, I will do a DCF. Usually won't go through a three financial statement DCF, but do more of a pro forma earnings or DCF, usually only 1 year out. So one thing that I think is kind of an intrinsic weakness of the sell side is that they really try to model things out way too far into the future without really having a solid basis for knowing what the future looks like. So I try to handicap that by using conservative estimates and not going out that far into the future. So that's most of the process.
John, do you want to explain a little bit what DCF is?
Oh yeah, sure. A DCF is a discounted cash flow, and so basically that's just where you take the financial statements that the company provides to the SEC, and you put them in Excel, and you kind of pick apart what all of the growth aspects of it are, and all of you make a best estimate of what the discount rate is, and then you discount the cash flows into the future. And so where my process is a lot different is that I don't go that far into the future because I don't see a lot of value in doing that. And since I look at a ton of stocks, I can really kind of afford to do that. And if something doesn't, play out in a good way, then I can just start looking at a different stock. So it kind of frees me up to have more time to do more of the initial screening, which at the end of the day I think really adds more value. So one trade that I did recently spawned from a conversation I was having with through the UCLA investment fund, which I was part of. We got to meet with a bunch of different asset managers, and I had the pleasure of meeting Monish Pabrai, who's a pretty close personal friend with Warren Buffett, and he runs a hedge fund down in Newport Beach in California. He's a really, really smart guy, and you can just tell it by the way he talks. And since he runs a hedge fund, he has to publish what his holdings were over the past 3 months ago. And so one of my friends had looked up what his holdings were, and we happened to know that he owned a bunch of auto stocks, so in particular Ford and GM. And we kind of asked him about why. I mean, they were trading very cheaply at this point in time in about May of this year. Actually, I guess it was March. And a lot of us were pretty bearish about the auto industry, even though the multiples were so cheap. And so we were kind of wondering what his rationale was. And his motivation for owning those companies did not have to do really with the auto cycle, because when sell-side analysts try to forecast those companies, they tend to kind of obsess over peak auto sales and when is that going to happen. So again, this kind of art of forecasting things that are just kind of inherently hard to forecast. And one thing that Monish was saying that was really interesting is that he wasn't really interested in the auto sales aspect of it, because he finds that to be almost impossible to be able to figure out what that's going to be. But he likes this captive finance arm aspect of it. And that is the part of the company that originates loans to customers. And so rather than being really driven off of auto sales, this aspect of the company actually, when you originate a loan, that has a 4 or 5 or 6 year of potential earnings in the future. And so that's based on the weighted average tenor of what the loans are. And so essentially, these make up a pretty stable source of revenues and earnings, and they're much more predictable. And so that was kind of driving his decision there. And so I kind of came out of this meeting thinking, why can't you just own that part of the company? And obviously it was a conundrum that it's a captive finance arm, because you can't just buy that unless you're buying it for the benefit of potentially having a breakup in the auto industry, but that's probably not going to happen. So I tried to figure out if there were companies that traded alone that did this. And so I just did a Google search, and a bunch of companies came up. And this one in particular, Credit Acceptance, was super cheap. I think it was trading about 10 or 11 times earnings. And so, digging into their business model, I wanted to see what kind of differentiated them. And when I looked through their 10K, the thing that stood out was how well they had performed through the last recession. And so that was really important to me because, like I said earlier, no one's going to be able to predict when the next recession happens. And as I did more digging and read through, earnings transcripts and different 10Ks, it occurred to me that even though they concentrate on this niche market, which tends to be heavily subprime, and so it is, people with lower than 650 FICO scores, I think it's 95% of their business. And so right away it clicked that, the reason the multiple isn't higher is because people hate their business model just because they see that. And so as it turns out, they just have a huge market share in this business. because FICO scores are just not very good predictors. I mean, they're okay, but it's kind of like a beta in the market where beta only captures 70% of the regret. It can only explain 70% of the regression. A FICO score is kind of similar in that it's a pretty good cursory, measure of risk, but it's not picking up the whole story there. And so these guys have been in the business since the 70s, and they've rode out all kinds of cycles. Since they've been around, they've beaten the S&P by over 100 times. They've gone up, many multiples of the S&P 500 through every cycle. And so what happens is that when the recession comes, they actually have so much data around their loans seasoning. They actually know they know when to pare back that risk. And at the same time, 80% of the principal risk is actually tied to the dealership level that they use to kind of help them with the sales process. And so they have, are very invested in this, and they do it very well. And so they just kind of own that space. And then furthermore, when the cycle starts to turn and auto sales really do start to peak, that's when the economy starts getting bad, and they get all this positive selection effect from high FICO score people dropping down into a lower FICO score bracket. And so they get to go after those people essentially. And so they ride out the cycle that way, basically. And as the next slide will kind of show, when I look at sourcing investments, these two red lines are really important to me. So those margins are just margins that you hardly ever see. I mean, they're definitely over, the 95th percentile of the S&P 500. And look at in the sales growth. It's hard to grow sales like that, but maintain your margins. If you have margins that are kind of resilient like that, that means that people aren't really able to penetrate their business model, and they're kind of not impervious to competition, but they're way better at cutting it off. And part of that is because it's not a very sexy business. People don't want to go into it. And so, as an investor, that's just something you really like to see. And so this next slide, this is what I was talking about, going through and seeking out information about how it did through previous cycles. And so this was really interesting to me, is that between 05 and 06, the GAAP earnings per income per share went down. That's actually a year before the crisis happened. So it's kind of a leading indicator, to be honest. And then it actually went up through the recession. So it tends to be, I don't want to say it's anti-cyclical, but it's definitely, the earnings are just kind of monotonically increasing, which is something as an investor that you just really like to see. And so the reason that the stock has gone up so much for the 30 years they've been around is because it just follows this fundamental strength. So that's kind of most of the story. And then this is just showing how much they've outperformed the S&P. This is since inception. So as you can see, it's gone up, many multiples of how much the S&P has gone up. And then this is, this is just what they kind of trade around. So this is the price to earnings ratio, and this is that ratio plotted over time. And so you can see that they don't really get a lot of credit. They kind of they seem to hang out around this low, 10 times. Right now the S&P is right around here at like 21 or 22. And you can see they're still well below that. They're around 16 times. So that means that they're intrinsically undervalued. And that should revert. I mean, you could argue that this is based on this multiple is based on an industry multiple, but it would be hard to figure out what that industry is. I mean, their competitors are all, parts of banks. They've got Santander over here that they're fighting against. They've got Ally Financial. Those companies typically don't have enough disclosures about the business they're doing, and they have performed worse, and they typically abandon that business in the down cycles because they're not as good at it as these guys. So, in my opinion, this should be a higher than market multiple because it's a safer than market company. but it'll probably never get there, but it should get closer.
Thanks for watching the video. You can also follow John's trades and his live returns on Keel.io. Every month, we bring speakers who have successfully invested their personal money to share what they have done and what they are going to invest. To ensure their past track records, all of the speakers' returns and trades have been verified through Keel. If you like the content, make sure to subscribe to our YouTube channel, like our Facebook page, or join our meetup groups in Boston area. Thank you again, and we'll see you next time.